Hello everybody, it's Tortoise Investing. Today we're going to be taking a look at 3 best stocks to buy now using Qualtrim Insights to look over some metrics about these 3 holdings. Now if you're new, hit the subscribe button, drop a like. I greatly appreciate it and it makes the YouTube algorithm very, very happy, and it makes me happy. So, without further ado, we'll go ahead and take a look at these. But here is a quick little portfolio update. We are up 26.91% year to date. These are our holdings. I really like how the portfolio is doing so far year to date. Again, Ulta Beauty's just killing it, up almost 24%. CNI is up 12.8%. And the bottom 2 positions, SCHD and Hershey Company. So if Hershey was to dip down in the 180s, I'd probably start nibbling at it again. But for right now, I'm pretty happy with my holding size. And as a comparison, year to date, if the S&P 500 is up 19.91%. So we're beating the market by 6%. All right, let's go ahead and take a look at the 3 stocks. None of this financial advice. Always do your own research. And Canadian Pacific Railway. Having just free cash flow yield, just a little bit over 3%. Dividend yield, 0.75%. And a payout ratio of 23%. Revenue's been growing at a rate of 6% over the last 5 years. And the free cash flow has been increasing at a crazy rate, 30.53% over the last 10 years. This company is going to be seeing some more accelerated growth because if you didn't know, they recently they're doing a merger with Kansas City Railroad, and that is going to make it to where it's the only railroad that is connected from Mexico through the United States into Canada. So they have all those covered, and they are expecting a great increase in revenue, cash flow, and they're going to be using that to buy back shares. That's the thing that railroad companies love to do, and they are focusing on paying down their debts. They do have a bit of leverage, but that is something that management knows, and they are going to be tackling that. EPS over the last 10 years, up 21%. The debt, as I said, is an issue, but they are aware of it. It's $21.76 billion right now, and their EBITDA as of last year was $5.65 billion. So it is leveraged about 4.5%, somewhere around that area. They are going to work on that. The dividend over the last 10 years increase in rate is 7.36%. So you have some nice inflation beating dividend growth. And if you look here, they did issue out some more shares. Again, this is part of that acquisition, I'm pretty sure. And once things are settled through with all of that, they are going to, they're going to start buying back those shares again, and that's going to help with their return on capital employed. That's usually been hovering around the 15 to 13s area, it looks like. Again, market average is 9 to 10, so that's pretty good. And another thing with this company, their capex, they don't have to spend a lot of money to make a lot of money. If you're looking at your companies and you're seeing that the revenue is going up 5%, but their capex is going up 10%, well, that's a big old red flag, and we don't have that here with Canadian Pacific Railway. Next up, we got Unilever. Probably saying that wrong. Just free cash flow yield of 4.51%, got dividend yield 3.88%, and a payout ratio of 48%. Now, they recently did a change of their CEO, and they are adapting a strategy that old Procter & Gamble's used forever. And I think that that's definitely going to help the company going forward. Now, they are down around their 52-week low here. I think they're at the 52-week low. Let's take a look. Yep, they are hovering right around the 52-week low. It was actually recently back in October, but they are not too far off from that at 47.94. Take a look here at the revenue. Revenue growth's been kind of flattish, but over the last 2 years, looks like we are back to growing again, 8.83%. Free cash flow, again, looks like it is starting to go down a little bit flat, but again, management's going to start working on that. There's a new CEO in town, and I am more than confident that this company is going to get things back on track. EPS been growing at a rate of 6.86% over the last 10 years, and their debt, see here, quarterly, that's not working, 21.46 billion. Their EBITDA was $13 billion, so my rule of thumb is I usually don't like companies that have more than 3 times their EBITDA in debt. This does not have that problem. The dividend's kind of a little bit all over the place, but I think that might have something to do with currency conversion. I think this is a foreign stock, but it is on the you can get it on your normal brokerages. But I like it. I think they've got some good products and stuff. Shares outstanding. Is it going to show for the quarterly? No. But if you look here, they have been buying back their shares at a rate of 1.29% over the last 10 years. So they are chopping at that share count, which you want your companies to do. It gives you a bigger and bigger piece of the pie. And if you look at the return on capital employed, 17.6, 17.29. And as of last year, over 20%. That is very strong. CapEx, if you see, is not an issue. Very similar to Canadian Pacific. Again, they're not having to grow their CapEx to grow their revenue streams, which you like to see, because if they're having to do that, it's just a company it's just a disaster waiting to happen. And lastly, BristolMyers Squibb, they are down over 30% year to date. This might be a good buying opportunity. Just free cash flow yield 10.83%, got a dividend yield of 4.54%, and a payout ratio of 57.8%. Take a look at the revenue. Revenue's been growing at a rate of 10% over the last 10 years. The free cash flow has been increasing at a rate of 23% over the last 5 years. Very nice. Got some great upward momentum going there. EPS, 9.78% over the last 10 years. Their debt, let's see here, quarterly. They are paying down their debt, and it looks like they are focusing on that pretty hard. It's right at $32 billion. Their EBITDA last year was $19.92 billion, so there's no issue there whatsoever. It's not even 2 times leverage. And the dividend's been increasing at a rate of 5.54% over the last 10 years. And they did just announce a 5% increase along with that. And if you look here at the shares outstanding, it was pretty much it was at 2.29 billion, and they're down to 2.06 billion. So they are buying back shares slowly but surely, and they did announce a $3 billion share buyback plan. So they are wanting to take full advantage of this stock being down 30%, which yet again, you want your company to be buying back cheap shares. That's the reason I think that they did a little bit of a smaller dividend hike, so they can buy back more shares, which I prefer that anyways. That's the reason I like Apple so much. Apple don't give you big old dividend hikes, but they buy back shares aggressively, and that's $3 billion. Ain't nothing to, that's a pretty good amount. And return on capital employed, 2020 was at 5%, 2021 is 11.6%, 2022 is 13.78%. So you have some upward momentum going with that. And again, same with the last two. Their CapEx does not look like it is an issue. There's no giant fluctuations here. And that's 3 best stocks to buy now. Again, always do your own research and stuff. Make sure to hit that subscribe button if you haven't, and drop a like. And until next time, take care. See yous.